The US stock market looks calm on the surface right now, but the real volatility is building underneath. This latest rate decision isn't just a 25 basis point cut, it completely rewrites the funding roadmap for the next year. The cut is only the beginning. The balance sheet expansion is the hidden line. Hey everyone, I'm Peter. The US market just crossed a major turning point. This meeting wasn't about a simple rate cut. It was the start of a new round of capital choosing sides. The 25 BP cut was fully priced in, but the timing, pace, and scale of balance sheet expansion all came earlier and stronger than Wall Street expected. Today, I just want to give you one takeaway: who is quietly benefiting and who is slowly being left behind. Let's set the framework clearly. The Fed lowered the federal funds rate range by 25 basis points to 3.5%, 3.75%, exactly as expected. But what truly caught the market's attention wasn't the 25 bips, it was the official launch of the Reserve Management Purchase Program. That's roughly $40 billion of short-term treasuries purchased every month. The official explanation is to stabilize money market rates and manage bank reserves, but for asset prices, it reduces to one sentence: liquidity is finally shifting toward easing, not tightening. Some people are still arguing whether this counts as real QE. Honestly, I don't care what it's called. I care about two things. First, whether there will be more money. Second, where that money will flow first. And right now, it's obvious the messaging must stay cautious. But operationally, the Fed is already loosening the system. For traders, the only thing that matters is positioning yourself where the liquidity is about to go. The dot plot completely split this time. Some want another hike in the future. Some want to hold steady. Some want multiple cuts. Some want fewer cuts. Every faction exists. The median path shows one cut in 2026, one cut in 2027, and no change in 2028. Overall hawkish. But the market didn't buy it at all, because over the past year, this chart has been wrong so many times that traders now trust data and price far more than a distribution map of who stands on which side. How do I treat the dot plot now? As an internal political map showing you the degree of disagreement, not something tradable. What actually shifts expectations is not how many cuts someone draws on a chart, but the next few months of hard data: jobs, CPI, wage growth. If the data gives room, the real easing path will be gentler than the dot plot implies. If the data doesn't give room, no amount of verbal imagination matters. Now to the press conference before the meeting. Financial media repeatedly hinted the speech would be hawkish, emphasizing sticky inflation and warning markets not to expect fast easing. But when he actually spoke, the tone was neutral, even slightly dovish, acknowledging inflation remains elevated, but also that the labor market has cooled, describing the outlook as solid growth, and specifically highlighting AI data center spending as support for business investment. In other words, he had to keep a serious face, but the message was clear: they're not lifting rates again, they're preparing to slowly guide them down, just not too quickly. When I listen to these speeches, I never obsess over adjectives. I look at two things: did the index break key support during the speech, and did bonds implode? If neither happened, it means the market understood. Stay alert, but don't panic. Back to the balance sheet expansion. Many institutions expected the Fed to announce RMP now but start in January. Instead, they said they'll begin buying short-term treasuries this week. That's faster than expected. The stated purpose is technical, to stabilize money market conditions, but the real effect is this: bank reserves rise, short-end pressure eases early, and the entire financial system gets an extra layer of liquidity protection. Think of it this way: while everyone was still arguing about one more cut or not, the Fed already laid down the safety net underneath. For equities, this net doesn't guarantee a huge rally, but it does make hesitant capital more willing to dip a toe in. My approach is simple. I won't YOLO into the market just because of balance sheet expansion, but I will allocate more room to assets that respond fastest to liquidity. On the index side, the S&P 500 had around 6,900 on the decision candle, just shy of the 7,000 options wall. That area is packed with massive call and put positions, a hot spot of sentiment and positioning. Volume increased, but not enough to call it a decisive breakout. It looked more like short covering, hedges being unwound, and some momentum buying, a technical rebound rather than a structural shift. So I don't treat this candle as problem solved. I focus on two things. First, whether the index can stay above 6,900 in the coming days instead of pumping one day and dumping two. Second, if we get a meaningful pullback towards 6,700, that's where I prefer adding exposure, not chasing when we're one step away from 7,000. The best entries rarely happen at the most exciting moments. Small caps reacted much more directly. The IWM jumped over 2% intraday. Even after pulling back late day, it still outperformed the major indexes. Why? Because expansion plus liquidity plus risk appetite, once any of these improves at the margin, small caps feel it first. They don't have the cash flow stability of the giants, but give them a little water and their price elasticity explodes instantly. But elasticity cuts both ways. For me, small caps are only two words: lightweight and fast-paced. You can ride a liquidity pop, but you never treat them as core holdings. Heavy positions should still go to companies that benefit from easing and earn real money. Small caps can steepen your return curve, but they should never decide whether you survive the next drawdown. Now, individual stocks, starting with Oracle, cloud infrastructure revenue grew 68% to $4. 8Bs, showing AI-related demand is accelerating. But traditional software revenue, the highest matcha segment, fell 3% to $5. 9Bs, add the debt burden, and the market naturally zooms in on slowing software plus high leverage, pressuring the stock. For me, Oracle goes into the watch closely list, not the buy now list. I need one of two signals: either software stabilizes or returns to growth, or the stock gets cheaper and prints a high-volume stabilization pattern. Chasing it now as a cloud plus AI play is more risk than reward. Treating it as a medium-term candidate after a structural repair makes more sense. Adobe is different. Fundamentally, the earnings were fine. Revenue, profit, operating cash flow, RPO, all solid. But on the chart, every rebound since May stalled exactly at the 6-month moving average. After earnings, the stock once again hesitated there. Classic, fundamentals okay, trend not opened yet. For this type of stock, I'd rather wait for a real breakout above key moving averages and buy the retest, instead of guessing under the line. You give up a little early profit, but gain much higher conviction. My rule is simple. For trend stocks, trade with the trend, don't gamble. Then, Nvidia, on one hand, repeated rumors about high-end chips flowing into sensitive regions. On the other, the company is developing software to track Blackwell chip locations to reduce gray market risks. Short-term, this adds noise and suppresses valuation expansion, but from an industry standpoint, as long as AI infrastructure demand remains intact, these compliance efforts strengthen Nvidia's dominance. So I never let Nvidia's day-to-day swings dictate my view. I watch three lines: whether AI compute demand cools, whether data center investment drops sharply, and whether long-term orders are cut systemically. If none of these break, a high-level consolidation is just using time to replace price. But if one day you see huge volume long red candles with no major news, that's when I'd actually consider reducing. Space-related stocks exploded after news that a major aerospace firm may push for an IPO. Listed companies holding its private shares soared, and some pure sentiment names rallied on nothing but a headline. Space as a theme has strong storytelling power, and once linked with a writing or exit channel, short-term money piles in. But you must know what you're doing. If you're using small positions for short-cycle emotional trades, fine. But if you think these are your new core assets, be 3 times more cautious. Only a few companies in this sector truly deserve long-term study. Most are meant to spike and fade. I'll ride the wind, but my safety rope stays tied to companies with real cash flow. Back to contract-driven names, PLTR just secured a 448 HINS defense contract supporting naval AI applications. That boosts revenue visibility and strengthens its moat in public sector work, but critics note its valuation is far above the market average, making it vulnerable to any slowdown in growth. For me, PLTR isn't about expensive or not, but whether its order curve keeps rising. If contracts keep growing in size and frequency, time will digest valuation. If orders flatten or shrink, high valuation becomes danger. I trade this name with rhythm, not belief. Belief doesn't stop drawdowns. Mr. VL wrote a rumor and clarification roller coaster. First, a report said it lost a major cloud customer design win. Stock dropped hard. Then management denied it, saying relationships and orders remain stable. Stock rebounded. A classic fear spike, fear-released pattern. What I learned, sometimes stocks fall not because of fundamentals, but because of uncertainty. Institutions instinctively cut when they smell trouble. then decide later whether to come back. We retail investors can get the truth faster than them, so the key is controlling overall risk during uncertainty, not stubbornly fighting it. Now, the old sentiment names like GNE and Open, declining revenue, missed earnings, and unclear long-term business models, inebriates drifting lower, liquidity improving environment. If a stock still can't rise with the market, it means capital is done funding the old story. We've shifted from tell a good story, and it goes up to show me real cash flow. So, if you still hold a bunch of pure sentiment names, at least ask yourself honestly, do they still belong in your next 2-year plan? Are you hoping they save you, or just unwilling to let go of old memories? Markets rotate. Most people lose not because they're wrong, but because they don't realize the rules have changed. At this stage, I prefer less romance, more realism. Put this whole meeting together, and you'll see the U.S. market now isn't a fragile high tower, nor a mindless bull market where everything rises, but a clean fork in the road. One side, balance sheet expansion, cuts, and improving liquidity supporting valuations. The other, internal division, a hawkish dot plot, and lingering macro uncertainty. Investors are consolidating high, small caps are most sensitive to liquidity. Tech is waiting for trend confirmation, cyclicals and financials are lifting gradually. My plan from here has only 3 parts. First, use rates and bonds to define my overall risk limit. Second, use index structure to decide whether I attack or defend. Third, use sector rotation to decide what to buy more of and what to reduce. I'm Peter. Tell me in the comments whether you're leaning toward adding tech, using liquidity to buy small caps, or reducing risk. See you in the next episode.